Boeing's recovery, shrinking losses, rebounding jet deliveries. Imagine the roller coaster ride that Boeing has been on lately. The aerospace giant has seen its quarterly loss shrink significantly, but its shares have taken a dive. Let's dive into the details and see what's driving this unexpected turn of events. Boeing's quarterly loss has more than halved, and it's much smaller than analysts had anticipated. This improvement comes as the company ramps up its jet deliveries, recovering from a regulatory crisis and a major strike that halted most production last year. But here's where it gets controversial. Boeing's financial improvements are tempered by the announcement that certification of the new 777-9 and 737 MAX 7 and 10 models will not happen until 2026, another setback for those programs. The company previously said it expected to finish certification by the end of this year. Boeing CEO Kelly Ortberg told CNBC that the company is still developing solutions to address problems with the 737 MAX model's engine de-icing systems that are stalling certification, which is proving a little more tricky than anticipated. During the interview, Ortberg praised President Donald Trump's aggressive use of tariffs to hammer out trade deals. "I like the way this tariff situation is playing out," Ortberg told CNBC. "It's good for our business, is good for aerospace, and will create jobs in the United States." The US and EU agreed to exempt aircraft and aviation parts from tariffs. However, raw materials such as steel and aluminum remain subject to steep duties. Boeing's financial performance is a mixed bag. The plane maker posted an adjusted core loss per share of $1.24 for the quarter through June, compared with a $2.90 loss a year ago. Analysts had expected a loss of $1.48 per share. The plane maker's free cash flow usage, a key metric for Wall Street, was better than expected, signaling an improving cash position. As we continue to execute our safety quality plan, there's more stability in our operations, Ortberg said in a letter to Boeing employees. Boeing's commercial plane division will lose money through the year, but free cash flow looks to be positive by year-end, Boeing Chief Financial Officer Brian West said during a call with analysts. In May, the company produced 38 737s, and production has been stable since then, according to Boeing. The company expects to shut down its 737 shadow factory in Moses Lake, Washington, which supports its main production lines, by the end of the year, West said. The U.S. Federal Aviation Administration capped the production of Boeing's best-selling 737 MAX jets following a mid-air panel blowout in a nearly new jet in January 2024. "We plan to seek FAA approval to increase to rate 42 when our key performance indicators, KPIs, show that we're ready," Ortberg added. The agency will review Boeing's supply chain before allowing a rate increase, FAA Administrator Brian Bedford said last week. He called Boeing's efforts to improve production quality real, but embryonic. Boeing delivered 206 737 MAX jets through the first half of the year, compared to 135 a year earlier. Across all commercial jet programs, it delivered 285 airliners through June, compared to 175 during the same period in 2024. Wall Street closely tracks aircraft deliveries because plane makers collect much of their payment when they hand over jets to customers. Boeing also increased 787 production at its plant in Charleston, South Carolina, from 5 aircraft a month to 7. The company expects to deliver more than a dozen 787s that have been delayed due to supply chain problems, West said. Through the first half of the year, the plane maker booked 668 orders, or 625 net orders, after cancellations and conversions. In May, Boeing's Defense, Space, and Security Division resumed deliveries of its KC-46 aerial refueling tanker to the U.S. Air Force, after finding cracks in at least 2 new aircraft this year. The company started ground testing of the MQ-25, a refueling drone ordered by the U.S. Navy during the quarter. Members of the Machinists Union at the Defense Division overwhelmingly rejected a 4-year contract offer on Sunday. The union represents 3,200 Boeing employees, mostly in the St. Louis area. If negotiations stall, union members could approve a strike as soon as Sunday. A strike would be much smaller than the one Boeing endured last fall, when 33,000 machinists at Boeing's commercial plane division walked out for nearly 2 months. "We'll manage through this," Ortberg said during the call. The division earned an operating profit of $110 million, compared with a loss of $913 million a year ago. It reported free cash flow usage of $200 million for the second quarter, compared with analysts' expectations of $1.72 billion, according to data compiled by LSEG. Boeing burned $2.3 billion in free cash during the previous quarter and $4.33 billion during the second quarter of 2024. Revenue for the quarter rose 35% to $22.75 billion, beating analysts' estimates of $21.84 billion. And this is the part most people miss. Boeing's journey is a testament to resilience and adaptability in the face of adversity. But the question remains, will Boeing's strategic moves and financial improvements be enough to regain investor confidence and secure a stable future? What do you think? Share your thoughts in the comments below. Boeing's Q2 results: loss narrowed, revenue up, and union struggles. Boeing's Q2 results show mixed signals. Profits dip, but revenue soars, outpacing Wall Street's hopes. By the Associated Press, July 29, 2025. On July 27, 2025, Boeing announced a potential labor crisis at 3 St. Louis area factories, where over 3,200 union workers might walk off the job after rejecting a proposed contract offering a 20% pay raise over 4 years. This decision adds tension to an already challenging year for the aerospace giant. Topics: Boeing, revenue, loss, deliveries, contract, strike, safety, quality. Despite a narrower loss compared to last year, Boeing's second quarter earnings revealed a resilient business. The company reported a $611 million loss, 92 cents per share, for the 3 months ending June 30th, down from $1.44 billion, $2.33 per share, in the same period of 2024. Adjusting for one-time gains, the per-share loss was $1.24, better than the $1.54 per share analysts expected. Shares rose slightly before the market opened on Tuesday, reflecting investor optimism. Revenue hit $22.75 billion, up from $16.87 billion, driven by 150 commercial plane deliveries versus 92 in the prior year. This performance exceeded Wall Street's forecast of $21.86 billion. CEO Kelly Ortberg highlighted progress in strengthening safety and quality, stating, "Our fundamental changes are delivering improved results as we stabilize operations and deliver higher quality products to customers." He emphasized the company's focus on restoring trust and navigating a competitive global market. Boeing has faced mounting challenges in recent years. The upcoming strike at St. Louis plants could disrupt production, with a cooling-off period delaying action until August 4th. The International Machinists and Aerospace Workers Union voted overwhelmingly against the contract, which would expire at midnight Sunday. Last fall, Boeing offered a 38% wage hike over 4 years to end a 53-day strike involving 33,000 workers. Meanwhile, the National Transportation Safety Board found that lapses in Boeing's manufacturing oversight, combined with FAA inspection failures, contributed to a door panel thaw on Alaska Airlines Flight 1282 last year. Boeing pledged to review the report and improve safety standards. The 737 MAX, Boeing's best-selling plane, has been plagued by safety concerns since 2 crashes killed 346 people. In May, Boeing avoided criminal charges after agreeing to a deal with the Justice Department for misleading regulators about the MAX's safety. Last month, a 787 operated by Air India crashed shortly after takeoff, killing at least 270 people. Investigators have yet to find flaws in the model, which has a strong safety record. But here's where it gets controversial. Can Boeing truly balance profitability with safety? As the company navigates these challenges, the question remains, will its focus on recovery outweigh its responsibility to public safety? What do you think? Share your thoughts in the comments below.